Next on our list is MMI, formed of course from the combination of Metropolitan and Momentum back in 2010, and it's done quite a lot of work to synchronize its systems and take costs out of the system. And it has the same broad-based business of asset management, investment-related products, employee benefits, etc. Market capitalization 36 billion rand, not small. Price earnings ratio of 12.1, dividend yield high at 6.9%. Anything specific to mention here? I mean, they've got the mixture of client base at the top end with the old Momentum offering, and Metropolitan more at the middle and lower income, sort of funeral insurance and life type policies.
Exactly, and for me that's where the problem comes in, if you want to call it that. It's still two businesses from my mind, looking from the outside in, with two different brands, so you don't get that coherence as what you would with some of the other companies.
Yeah.
They spent a lot of time with integration and they got the benefits from that, but we now call it the second chapter, where now that that's behind them, what's next? They tried to venture into short-term insurance. This is where I mentioned it's important to get your underwriting right. They didn't quite get it right at the beginning, made significant underwriting losses with that venture. So a few uncertainties about what next for MMI.
Nicholas Kruger has been in charge there. They've been doing a little bit of asset management reorganization and pulling some of their property derivative positions in, Eris Property, Manco acquisition and so on. Centurion based, involved with sponsoring the cricket. I'm scratching around here. Let's have a look at the share chart, because that'll obviously reflect the slightly modest mood that's prevailed there. Just one other comment about them. Wayne McCurry, who's an employee there, always points out how they're very conservative with their capital base, and that they tended to shy away from equity market exposure and to favor cash instruments, bonds and other things, which looked like a bad idea at some point, but other times looks like a good idea. How does it look to you currently then?
Well, it makes the returns from the excess capital of the group less volatile.
Yes.
But it also means that through a volatile cycle, also probably a total lower level of return versus if you did have equities in that. So I prefer a slightly lumpier but higher return personally. So I prefer someone like Sanlam, who does have some more volatile equity exposure in the excess capital.
So it sounds like you're leaning towards not hot then.
Yes, it's cheap, high dividend yield. The one that's trading at, last time I looked at, a slight discount to embedded value. But for me, that's not enough. They need to sort out certain strategic issues, so I'm saying not hot.
Okay, I'm going to go with hot anyway, just because on the whole, this part of the market looks a little too cheap to me.